The US government is expected to borrow $2 trillion a year for the next decade. That's huge and unprecedented. Investors are starting to think that all this borrowing could have some major impacts on stocks, bonds, and all kinds of other investments.
That's Dion Rabouin. He's a writer for the Wall Street Journal, and I think he does an excellent job of explaining complicated material in an easily understandable way, and he uses excellent graphics. So I want to share this with you, and I want you to particularly relate what he's saying to the corporations that you own. He's going to speak specifically to big tech. I want you to get that, but I also want you to understand what he's saying about the unintended consequences of increasing interest rates, how the service of the debt, whether it be the corporations or the nations, is going to bury any profits of the future unless you find another way to generate profits. So listen to this. It's not financial advice. It's financial education. And Dion does an excellent job of explaining it. And then we'll get back to it.
Best of Us Investors presents Kerry Griegmeyer.
I'm going to explain why the government is borrowing so much money, why all that borrowing will impact markets, and what this could mean for the investing world in the near future. Let's get into it. The U.S. national debt recently hit $33 trillion, and the Congressional Budget Office estimates our debt could surpass $40 trillion in 5 years. That's because, even though the government isn't rolling out any big new stimulus programs, it is bringing in a lot less revenue than it did over the past 2 years. Revenue is basically shorthand for taxes. The government is collecting less taxes because people are collecting less capital gains on the sale of things like stocks, businesses, and houses. Remember, you pay taxes in the year following taxable events. So the taxes from big stock and housing market gains we saw in 2021 were largely recorded in fiscal year 2022. The government is also paying a lot more in interest so it can borrow money to pay for the deficit. The interest rate on 2-year government bonds at the beginning of 2022 was less than 1%. Now, that rate is over 5%. When you're paying interest on billions or trillions of dollars in debt, that difference adds up. Jefferies' U.S. economist Thomas Simons is expecting the government to issue just under $4 trillion in medium and long-term debt in fiscal year 2024. And it's going to have to sell that debt at the same time that some of the largest buyers are cutting back. The Federal Reserve is the largest holder of Treasury bonds, but the U.S. Central Bank is projected to reduce its holdings by up to $60 billion per month moving forward. And the latest report from the Treasury Department shows China cut its holdings of U.S. government bonds to the lowest level since May 2009. China was the largest foreign holder of U.S. government debt as recently as 2019 and held more than $1 trillion in treasuries in early 2021. But the country has reduced its holdings by almost $300 billion since then. When there's more supply and less demand, that usually means that prices fall. For bonds, it also means that yields rise. Treasury yields reached their highest level in more than 15 years in September, and the mountain of new debt that's coming could push them even higher. Higher yields historically increase the value of the dollar and boost the attractiveness of safe assets like money market funds. Retail traders and professional money managers have pushed a record amount of cash into money market funds, which are paying the highest interest rates in decades. Higher yields also have made investments in risky assets like stocks less attractive. The thinking goes that if you can get a guaranteed 5% return on an asset that's a lot like a savings account, why take the risk on stocks? And because most public companies have to borrow money by issuing bonds, their costs will go up, which often makes them less profitable. This is especially true for so-called growth stocks. These are usually tech companies that have very high market valuations, even though they don't make a lot of profit. Tech has made up an increasingly large share of the benchmark S&P 500 stock index and is the backbone of the NASDAQ. With the outlook for the economy uncertain, you could see more investors start to favor parking their money with the U.S. government or leaving it in money market funds.
So let's see if we understand this. The cost of debt service is going up, which is going to bring down or bring up the deficit. That's transferable not only into the government, but also into corporations that aren't profitable. Okay, so the cost of debt service makes the government unprofitable, makes some companies unprofitable or less profitable. So as this debt service goes up, we need to be aware of it. And at the same time, as the debt service goes up, interest rates continue to go up because lending institutions don't want to lend into unstable companies. So the cost of debt even goes up further, and that brings stock prices down because stock prices are a multiple of their earnings. If their earnings go down because of debt service, because of higher cost of fuel, because of fear, these 4 guys may play into that in the future, we can expect the stock market to go down. So what do? Do we just suffer it and deal with it? Do we, because we want to avoid taxes? Well, I've talked to you about that before. There are ways to manage your taxes. And then at the same time, we better do some risk management. And I think Dion just gave you the outline that the risk is going up. The profitability or the security in bonds and treasuries, it could be up to 5%. So if we want to avoid the risk, maybe we need to go to cash. Does that make sense? I don't know. It does to me. Now, the other element of that is I want to see which of my companies have great debt exposure, as the United States does, and which of my companies is this whole scenario transferable to. So that's why I do an analysis on my website of the BUS 12 and BUS 13 stocks to see which ones of them have enough cash aside to pay down their debt and avoid this increased cost of debt, so to make me more secure in owning them. And then even though their revenues may go up, I have some that have high debt, and thus the cost of the debt is going to bring their earnings down, which will bring their multiple down, which will bring their stock price down. I do that on my website. Here's what it looks like. You can come over. In fact, we're now creating it so that if you have difficulty accessing it on the website, we mail it out to you every Saturday or Sunday in an email with the data and the explanations of the data as a part of our Platinum service. So if you want to be a part of that, if this is the kind of information you need to become a better investor, to understand it, because the next step is, rather than me giving you the information, I want to teach you how I gathered it. So if you so choose to become a better investor and gather your own information, and then come over to our technical analysis so you can put that in your quiver of arrows of investing knowledge, then you can do that as well. How do you do all this? You just get on the bus. You come to our website, you find this panel, that you click this level of participation, and you become a member of the tribe. I'll talk to you more about this in the future.